There are growing fears that small shareholders are about to be shortchanged if the ASX gets its way with new capital raising rules. The ASX is proposing a number of reforms to make it easier for small and medium companies to raise money. But investment bodies warn that small shareholders might be sidelines if the new rules come into play. Neil Woolridge reports.
It was an all-too-common feature in the depths of the global financial crisis. Large companies raising money in a hurry at a heavy discount, but in the process favouring institutional investors over small shareholders. Now there are fears the Australian Securities Exchange wants to put in place rules that will give small and medium companies even more scope to do the same thing.
The rules effectively bypass small shareholders without much consideration, and that's what we would like ASIC and the government to be aware of.
At the moment, all companies can raise up to 15% of their issued capital without shareholder approval through what's called a placement. The ASX is proposing to expand that for small and medium companies worth $300 million or less and let them raise another 10% of their issued capital at a maximum discount of 25% for those extra shares.
The changes to the ASX listing rules effectively allow companies to issue stock to anybody they really choose, or their advisor chooses, and avoid the existing small shareholders in the company. There's no requirement to issue stock on a rights issue basis to the existing shareholders in the company.
Shareholder approval won't be needed at the time of each particular capital raising, but companies will need to secure it in advance and then renew it every 12 months.
If the people have any concerns about it, then they won't vote for it. So I think there are some reasonable steps in process that does allow that type of thing to happen.
Vaz Kolesnikov argues that share issues should be pro rata so they don't dilute existing shareholders, and renounceable so investors are compensated if they don't participate. The Shareholders Association is worried that these changes could lead to control of companies being passed to shareholders with the inside running.
So certainly with small companies, which a lot of them don't have the resources to fully comply with the ASX corporate governance principles, the easiest route to capital will be finding a few selective investors and off you go. You've got your money within 3 days.
The changes are designed to help smaller companies like biotechs and mining startups raise funds quickly and easily and grow their businesses.
When you look at the overall market, it's good to see the ASX is coming out and doing some changes to try and attract additional investors to the market. Also, it's important that we keep up with the global standards that are going on.
David Horsfield says small and medium cap companies are more likely to attract sophisticated investors anyway, so the concerns about so-called mum and dad investors are misplaced.
And without the sophisticated investor coming into the small caps and mid caps, probably the actual amount of capital coming in would be quite small.
The ASX is still speaking to interested parties and industry groups before sending its recommendations to the Securities and Investments Commission. However, the government will have the final say on whether this change is accepted. And given that it knocked back the ASX proposal to merge with the Singapore Stock Exchange, there's no guarantee that this reform will be rubber stamped.